we've had a little discussion before this panel, and everyone has very diverse backgrounds. I think it'll be interesting to hear where they're all coming from. So starting from my left, Tom Mason, who is the laboratory director at Oak Ridge National Laboratory. He became director of the laboratory in July 2007. He's an experimental condensed matter physicist, and his primary research tool has been neutron scattering, supplemented by the use of X-rays and transport of thermodynamic measurements. So it'll be very interesting to hear what he's got to tell us about energy and the environment. Then after Tom, there's Bob Kavanagh, who's the chief executive of Luca Technologies, and who has 30 years experience in the energy industry, previously president and chief executive of Milagro Exploration, an oil and gas exploration firm in Houston. Then following Christine Ibe-Singer, the founder of E&Co, which is a company that leads investment in energy access finance in the developing world. Then Dr. Graciela Cichilnitsky, the author of the Carbon Market Protocol of the UN Kyoto Protocol, which of course comes to an end at the end of this year and currently is in the process of being renewed. Following to the left, Mike Whitner, the head of oil research and commodities research in the Americas of Societe Generale. Mike, who I speak to from time to time covering commodity markets, is a great person to quote in the newspaper because you can always quote next to a story about Iran and oil that he's a former analyst at the CIA, which always goes down well in the newspaper. And then finally on the left is Dr. Tom Malone from the Patrick J. McGovern. He's the Patrick J. McGovern Professor of Management at MIT Sloan. With that, I'll let them all just give a couple of minutes of how they're coming at this issue, which I think is quite distinct in everyone's case.
Well, as you heard, I'm responsible for Oak Ridge National Lab, which is a Department of Energy lab, and so this topic is very much at the center of what we do, primarily focused on what one of my predecessors used to call technological fixes. What are the solutions that could become possible through research that may be very much in the fundamental science domain but moves towards application in terms of clean energy distribution and end use. One of the other things that we do, which I thought might help frame the discussion, is we run something called CDAC, which is the Carbon Data Information Analysis Center, that every year tries to synthesize all the available data on economic activity and energy use in order to provide a definitive estimate of CO2 emissions. And it's been doing this for many, many years. So every year we get a new data point. And as an experimental physicist, I like to compare the data to the theory. And we have the opportunity to do this because in 2000, the IPCC, the Intergovernmental Panel on Climate Change, issued its report. And that included a number of projections of different scenarios for how CO2 emissions might evolve under differing sets of assumptions in terms of economic growth, policy changes, technological development. And there was a range of possible outcomes from aggressive action taken to mitigate CO2 emissions to more or less business as usual, which would represent maybe some of the worst case scenarios. So, of course, since 2000, CDAC has been doing its thing and collecting the data year by year on what's been happening to CO2 emissions. And what we see for the first part of the 2000s, from 2000 to 2007, actually the rate of growth of emissions was accelerating, and to some extent we were moving outside the bounding worst case in terms of the extent to which CO2 emissions were growing, because that was a period of relatively robust economic growth, coupled with actually an increase in carbon intensity, because much of the energy consumption growth was happening in the developing world and was being driven by things like electrification with coal-fired fossil plants. So from 2000 to 2007, we were pushing the boundaries of the worst case. Now, the story begins to get better because the story began to get worse. And of course, what happened was we had a substantial downturn in the economy. So the emissions growth actually turned around, and in 2009, we actually had a rather significant reduction, coinciding with a significant reduction in economic activity globally. And that's visible and substantial. It's also short term, and in fact, even in 2010, we can see with the economy picking up again, the rate of growth of emissions was 6.9%, which is actually, I think, one of the largest ever recorded. It was averaging about 3% per year in the first part of the 2000s. So what that tells us is actually, so far, we're not making much progress, despite things like Kyoto protocols and efforts across the world to think about the problem. The reality is that energy demand is growing. It's growing rapidly in many parts of the world, and we are still inextricably tied to fossil fuels for fueling that demand. And as a result, we are not seeing a turnaround in the trend for the growth, in the rate of growth of emissions. What that means is that if you look at the framing paragraph around this session, it talks about what are the opportunities to stabilize CO2 in a way that would limit us to around a 2 degrees C temperature rise. Given the amount that's already dialed in through the emissions to date and the built-in infrastructure, I think many people would say that 2% or 2 degrees is something we need to figure out how to live with, because that's happening for sure. And in fact, what we're really talking about is, where does it go beyond that? So I will have more optimistic things to say later, maybe as we talk about some of the technological fixes, but I thought I'd start with that.
Well, thanks for that very, very gloomy overview of where we stand. Over to an oil man, Bob.
Well, to continue the gloom, I'm the guy from the oil business. To talk about how I approach these kinds of issues that are the subject of today's session, I have to talk a little bit about myself. I've been in the business since the mid-'70s. I spent about 11 years on drilling rigs and frac crews and built gas plants and pipelines and all those things that you hear horrible things about today. And very early on in my career, I had some experiences that helped shape the way that I approach these issues today. Or very early on in my career, about 5 years in, I was burned in a gas well fire. And that really got my attention about the dangers of development of fossil fuel. And beyond that experience, I also witnessed over many years the practices of the industry where they destroyed groundwater, they destroyed surface, very irresponsible practices and policies during that period of time. I have to say it's gotten much better over these 30 years. It's not nearly what it was in the 1970s, but what I really committed myself to was trying to find something where I could contribute to sustainable, responsible energy development. And the track that we're on today, especially with and we'll talk about some of this stuff later, the shales and some of the big projects that require hydraulic fracturing and other processes that concern people so much, it's an unsustainable. It's an unsustainable demand, or unsustainable supply for the demand growth. And we talked about some of the demand growth, and it's only going to get worse. And so I started looking for something that I could do that I understood. I looked at wind and solar and biofuels, and I'm not a scientist. I don't understand any of those things, but I do understand natural gas and oil production. And I was introduced to this company, Luca Technologies, about 4 years ago, and was asked to take it over 2 years ago by one of the major investors, Kleiner Perkins, out of Menlo Park, California. Luca has developed a technology that is just a fabulous way of producing pure natural gas through existing wells without drilling new wells, without hydraulically fracturing, by using biotechnology. We produce natural gas from wells that have natural biogenic activity already there. And essentially what we do is feed the microorganisms that are in that environment, and they go back to work producing natural gas from old wells. And the competitive advantage we have, and the thing that I love about this technology, is we actually operate under EPA Class 5 drinking water rules. So our commitment to the environment is that everything we do does not degrade the quality of the air, does not degrade the quality of the groundwater. And that was very, very important to me. Obviously, burning natural gas adds to the global warming and CO2 issues. But since we are a hydrocarbon-based economy, if we can move as much as we can to a supply that's not as polluting as oil or coal, at least it's a step in the right direction to help lower some of those greenhouse gases. So that's my background.
Thanks very much. And Christine?
Sure. Well, good afternoon, everyone, and thanks for joining us. I've spent the last 20 years focusing on the issues of energy access in the developing world and looking at it from a market-based approach. I am a co-founder of an organization called E&Co, and up until the beginning of this year, I served as the CEO of that company, which is a U.S. nonprofit that provides business development services and investment capital to small clean energy enterprises in Africa, Asia, and Latin America. And over the course of my tenure at E&Co, we invested in over 180 businesses in the developing world, providing both enterprise development services, really working with entrepreneurs and project developers so that they understood what was happening in their markets, what the technicalities were of their project plans or their business plans, and then actually investing into those companies and stimulating local finance into those businesses as well. And we were one of the first companies that started using the term triple bottom line, where this is dating myself, but this is about 1996, when we actually started looking at how do you measure not just the financial returns of these businesses on the ground, but really what's happening socially and environmentally, being the impact on climate. And over the course of the last 9 months, I've been very much involved in the UN Secretary General's Sustainable Energy for All initiative, and I've served on the Secretary General's high-level group. And I've been focused on, my work product has been really looking at what are the financial interventions that are necessary to stimulate private capital moving into this space. The reality is we have 2.7 billion people who are cooking with traditional fuels. We have 1.6 billion people who don't have access to electricity, who have never seen a light bulb. The reality is if we're going to have economic development, if we're going to meet the Millennium Development Goals, we need to bring energy and modern cooking to these households. There's an insufficient amount of public capital. Governments can't do this themselves. The donors aren't going to be able to do this. We have to put in place the business models that stimulate private investment. So basically working off the very many business models across solar energy, wind, modern cooking, both in terms of LPG, liquid petroleum gas, for cooking, which is a much cleaner cooking fuel than certainly firewood or charcoal in the developing world, but still a fossil fuel. How do we move these households up the modern energy ladder? And that's what I've been working on and really looking at how do we get that private capital there to scale and really have impact.
Thanks very much. And Graciela?
Graciela Cicilneschi, good afternoon. A pleasure to be here with you and with this great panel. I guess I've been preparing for about 25 years to come to this event. I created the concept of basic needs, became the foundation for the theory of sustainable development that we are all talking about here, voted by 150 nations in the 1992 Earth Summit. In 1997, I wrote into the Kyoto Protocol the carbon market, which I had negotiated and worked with the U.S. Department of the Treasury as well as Department of State. And I was the U.S. lead author for the IPCC. And in the meantime, when I was not doing that, I was I had 2 PhDs from MIT and UC Berkeley in mathematics and economics, and I have taught at Harvard University, Stanford University, and at Columbia University and other places for a number of years. In addition to that, I created a global fund, which I named Green Power Fund, that is now approved, that was approved in Durban, South Africa, voted by the nations in December 2011. It's a $200 billion a year fund that I think should be devoted to building carbon negative power plants in developing nations. So this is a technology fix, an economic fix, both from the point of view of the global negotiations, but also from the point of view of private enterprise. And I see that I have colleagues here. We are all thinking along different but conversion lines, and I'm very grateful for that. I think I want to say that the problem is as serious as Tom said, and indeed the 2% is basically here with us. The 2 degrees is basically here with us. I think it's very difficult to avoid it because of the momentum of the situation and the fact that CO2 is stable, very stable. It stays in the atmosphere for over 100 years at least. And I also wanted to say that the technological fix without international agreements and a pure enterprise fix may not be as effective. In fact, it may not work. So I founded 4 years ago a company that I lead. I co-founded, and I am the CEO of a company called Global Thermostat. I'm trying to pronounce it right. I hope it's clear. Global Thermostat. So this company, it has a technology that the DOE knows laterally to extract carbon, capture carbon. The DOE does a lot of work on the capturing carbon, but from air. And it's very new, and it has the capability of transforming a coal-driven power plant into a carbon sink. So you know that 45% of the global emissions come from power plants, and you know because Tom said, and it's true, 89% of the source of energy in the world is fossil. These 45% of emissions that comes from power plants can only be resolved by dealing directly head-on with the issue of power plants and cleaning after them. But that's not enough, because cleaning coal power plants is a road to the past. It's trying to continue living with the coal and the fossil fuel. So this technology that I'm talking about is powered by heat. So you can take a concentrated solar power plant, use the residual heat, co-generate, and Robert will know exactly what I'm talking about because he must be having done that many times. So we are co-generating with the power plant using the low temperature heat, 90 degrees centigrade or less, which is residual and not very valuable because it's not productive, it's not efficient for the production of electricity, to run our system, which is a demonstrated technology. We have a live plant in Silicon Valley, and we are starting right now commercializing in India, in Germany, and in the United States. The bottom line is that the solution that has to occur, and everybody's converging in the same direction, is more energy. The world needs more energy. The world needs more energy. And the developing nations need more energy. All we can do is to make sure that the energy is available in a way that can actually clean the atmosphere at the same time, which seems like a dream come true. But this technology, this disruptive technology that I co-invented with a physicist called Peter Eisenberger, and is now going commercial, can do exactly that. I think I should stop right here, because otherwise I'm taking too much time. But I'm happy to respond to all questions. And one more point about JAG. No, the Kyoto Protocol doesn't expire in 2012. It is international law, and as such, it doesn't expire unless it's voted out. What does expire, or did expire in 2012, are the limits from the Annex 1, namely OECD nations, which were up to 2012. However, in Durban, South Africa, COP17, December 2011, the 2012 deadline has been extended first to 2015 and then to a global renegotiation, which is a mandate by the year 2020. So I have a book downstairs called Saving Kyoto that is on the table, just one copy, that can be seen with the history of all this. No, the Kyoto Protocol, if anything, is growing, is becoming more powerful. It's trading $215 billion a year in the European Union emission trading system. And now there is a mandatory cousin, which for non-arbitrage reasons is going to converge, and that is the state of California. So we have a bona fide carbon market in the largest state of the United States, and it's living and well. The carbon market is very important for the price part of all this. Again, I apologize. I hope I did what you wanted.
It's fine. It's very interesting.
Thank you.
Mike, tell us about the fossil fuel markets.
Okay, I'll try. So I guess I'm one of the markets guys in the room, and I guess also an oil and gas guy. Well, not as much as you. I'm a geologist with an MBA, so I've worked in the field as well, and I've done hydrogeology, and I've worked when I was in CIA, I did satellite remote sensing and all sorts of cool things. And I, got into energy market analysis. And after having a few years back, I've been in consulting and worked for an oil company and so forth. A few years back, I crossed over to the dark side and went to work for a bank. So what do? We care about markets. I spend most of my time here. We analyze markets. We forecast prices. We try to understand what's going on. But the main thing we do, I guess, in the real world is help our clients who are producers of commodities and consumers and refiners of commodities. And we help to try them run their businesses and manage their risks. And so I guess my angle on it, we're talking about climate change and what can, different ways that government policy can work, and how can we kind of try to work the market into some of those solutions, like several people have talked about. And I guess that's where we spend a lot of time, what I spend a lot of time doing. And I guess I'm a very practical guy, and government and policy can be an important catalyst, can help get new technologies and maybe new trading schemes and so forth, can kind of get them a running start. But in the end, the market has to be there, and things work or don't work because the price is right or not right, ultimately. And just some examples that are kind of in the news all the time. We've seen a lot this summer with the drought in the U.S. and corn prices, and what is that doing to ethanol prices? And, well, the U.S. consumes a lot of ethanol because the government a few years back said that we should. Now, there's pros and cons to that, but, going forward, I was on a conference call with a client the other day who was saying, well, is this thing going to, maybe it won't last. Maybe we'll end up switching to sugar-based ethanol instead of corn-based ethanol. Sugar-based ethanol is what they produce and consume in Brazil. And by the way, they can export it. So, there's lots of examples. Another example we've heard a lot about already is the carbon trading schemes. We have in the U.S. we have what's known as the CAFE standards, corporate average fuel efficiency standards. So these are all examples of things where governments, do play a role. But in the end, I would say, well, U.S. oil demand, just picking one example, U.S. oil demand peaked in 2005. Now, the recession we've had since 2008, or the sluggish growth, I should say, played a big role in that. But, really the CAFE standards weren't, had not been touched for a couple of decades, really, until the current administration got in, and that's going to play a role going forward. But if I look at what's happened, well, the U.S. has just joined Europe and Japan and the other industrialized parts of the world, and that their oil consumption and energy consumption is topping out and starting to decline. The real, as we've already heard, the real issue that we need to deal with going forward across energy, different types of energy, is emerging markets. Just to draw attention to another big example that's in the news all the time is, what's changing the U.S. energy landscape as we speak is shale gas, natural gas from shale, and oil also produced with the same techniques, hydrofracking. We've talked about that already. That really has, at this point, going forward, there are some, clearly some regulatory issues that need to be addressed. There are concerns about groundwater and so forth. But you know what? We got to this point, had nothing to do with any government policy. It was just technology. It was production costs coming down. It was people saying, companies saying, hey, we can make money at this. So, and meanwhile, it's changing the landscape of the U.S. So so that's just one observation on, the role of governments and policies versus the markets. And in the end, the markets have to be there. And using the U.S. shale gas and oil example, bringing me to the next point, which is I guess Jack wanted me to make a couple of quick comments on what had been talked about as the commodity super cycle. Now, that's a nice marketing term that someone at a bank probably came up with. But joking aside, we've had a couple of these super cycles in the past. One was in the 19th century, up until lasted a few decades, up until World War I. We had another super cycle which lasted from basically 1945 until the 1973 oil shocks. And it appears as though another one started, in the 2000s. Super cycles are basically driven by demographics, by urbanization, and of course also by income growth. As companies, get wealthier and move up the scale, they consume more energy. But really, my point is, oil prices last year and this year, just as an example, I know we're not only talking about oil here, compared to the peak, the all-time record set in 2008, right? Crude oil hit about $145, $150 a barrel. Just last year and this year, we haven't been actually that far off. We've hit on the order of $125 a barrel a couple of different times. Part of that was because of the Libyan civil war last year. Lots going on. But my point is, and what's very interesting, is the oil markets and markets in general are a lot less concerned. Financial Times and other places, occasionally will run a story saying, is the super cycle dead? Or maybe saying that it is dead. And I would agree with half of that. So the super cycle, like I said, if it's about demographics, industrialization, and urbanization, that's the demand side of it, right? The other side is the supply side. Now, in 2008, just to draw a contrast, the markets were very concerned that we were actually running out of oil, and that, in fact, we were starting to see signs of it, real time. There was very little spare capacity, for example, in Saudi Arabia, in OPEC. Not much more spare capacity nowadays, actually, but the markets are not very concerned about it. I'll just give you another example. 2008, when oil prices were at $145, $150, in my world, we do a lot with the futures markets, right, which go out 5 years, 8 years, and beyond. What was very interesting was not only was it $145 for oil that you wanted to buy next week, but the price 5 years out or 7 years out was also $145. Nowadays, or this year and last year, when we've had some price peaks, it's gone up at the front because people are worried about what's going on in the Middle East, for example. But if you go a few years forward, prices are $90 a barrel. The market is much more calmer. And the difference, I'd say, between now and this is a roundabout way of getting to the question, the difference between now and 2008 is while the demand issues are still there, right? Again, the demand side of the super cycle, China, India, emerging markets, the need for transportation fuels, the need for power generation, that's all there. But on the supply side, shale, what we've seen in this country has the markets and a lot of people much more relaxed about the supply of fossil fuels for the future, okay? Now, that may or may not be a good thing, right? High prices tend to force innovation and force the change that we're talking about. But the fact of the matter is, again, speaking as a geologist, shale is one of the most common rocks on the planet. We're not sure how much shale oil and gas is around the world, but there's probably some, and it's probably significant. So, the U.S. has just, got there first. So that, I would say, along with the fact that, one country, Iraq, has actually, compared to 4 years ago, after, 8 years of delays, Iraqi production is finally on an upward path. And one country does not change the long-term global outlook, but there's a lot of oil there, and they're talking about being another Saudi Arabia. And it's not going to happen on the time frame that they're talking about, but it'll happen eventually. So like I said, the demand side of the super cycle still exists, and I think by definition, we're still in one. You always have short-term industrial cycles and recessions superimposed on these broader cycles, right? The broader cycle is still there on the demand side, but on the supply side, we're a lot less worried. I'll leave it at that.
Thanks very much, Mike. And over to Tom, who can tell us how we ought to be thinking about the problem entirely differently.
So, as Jack said, I don't consider myself an expert on the sort of technology or the detailed policies of energy and climate, but the approach I'd like to bring to our conversation today is a different approach for solving the problem. I'm the director of the Center for Collective Intelligence at MIT, and what we've said is that this problem of climate change in particular is one of the biggest problems facing our planet today. I think most people on the panel would probably agree with that. It's really big, really complicated, very, very hard, as all the things we've heard so far already suggest. Those are reasons for pessimism. But there's at least one reason for optimism, which is that we now, as a species, have a way of solving really big, complicated global problems that wasn't even possible 15 years ago. If you think of things like Wikipedia, like Google, like the development of the Linux open source operating system, those are all examples where thousands of people all over the world brought their collective intelligence together and solved, or at least attacked, really big, complicated global problems. So we have a project in our research center called the Climate CoLab, whose goal is to apply this approach of internet-enabled collective intelligence to the problem of climate change. So we've developed an online platform and a community of over 3,800 people around the world who are using this platform to develop proposals for what we should do, we humans should do, about global climate change. So each proposal includes a description of various kinds of technical or economic or political or other actions the proposers think should be made. And at the global level, the proposals are also anchored in the actual physical and economic reality we face by including quantitative assumptions about emission reductions that the actions they proposed would lead to in different regions of the world. And then there's a computer simulation model built into the online platform that projects the likely impacts of those reductions on things like temperature change, sea level rise, and various kinds of costs. For the last 3 years, we've had annual contests, and the winners in the last 2 years have presented their ideas in briefings at the United Nations in New York and on Capitol Hill in Washington. Among other things, we've had one of the winners last year was actually a combination of the ideas from the 3 winners in the previous year. Another one of the winners was a team that was formed on our site. There was a climate activist from Florida and a sociology professor from the Midwest and a climate researcher from Australia. The 3 of them found each other on our site and developed one of the winning proposals together. So that's what we've done so far. What we're about to do is to say this is not just one big problem that you can solve all at once. It's a very complicated problem. When we started this project, things like Copenhagen global treaties were in the air, and we thought that maybe we and many people thought there might be a silver bullet for the problem. The phrase I heard recently, I didn't invent it, I don't know who did, was that what we actually have is a problem that doesn't need a silver bullet, it needs silver buckshot. So the problem of climate change is not something that can be solved by any one good idea at all. It needs hundreds of good ideas that together can solve the problem. So what we've now done is to break the overall problem down into many sub-problems, different parts of the actions that can be taken, like mitigation, adaptation, geoengineering, and various forms of all of those, different kinds of actors who can take those actions, governments, businesses, NGOs, consumers, etc., and of course different places that the actions can be taken all over the world. And for various combinations of those things, we're creating sub-contests where different groups of people and experts can come up with ideas about what to do. And in later stages of the project, we'll have integrated contests where people put together the ideas that came out of all those sub-problems into overall solutions that, or proposals that at least have some hope of solving the whole problem. So what we hope will come out of all of this are ideas and approaches and actually people working on these things that will be proposals or approaches that will be more innovative, more plausible, more feasible, and more likely to actually be adopted than anything that we would have otherwise developed.
Thank you very much, Tom. So there you have an overview of the problem. Quite a lot of doom and gloom, but a few ideas for solutions, and hopefully we have a bit of collective intelligence here today. So I'm not sure we're going to solve the problem of climate change right away this afternoon, but you never know, we might get a little bit closer. I'd just like to, from the point of view of a journalist, we've talked a lot in the different introductory comments that you guys have given of ideas, of solutions, of looking at the problem. The obvious solution seems to be that the politicians should regulate to do whatever it takes to prevent climate change from spiraling out of control. Across the panel, you have varieties of different interactions with the political world. Perhaps we start with Christine. How hopeful are you that that the political world can get its act together and act on climate change? And what do you think ought to be done from the political side?
I don't think in the markets that I've been working in, which is in Africa, Central America, and smaller countries in Southeast Asia, that is really the priority of those governments. I think there's a recognition of the impacts of climate change, particularly some in the small island developing states, about what will happen. But the reality is there's an economic development agenda and a poverty alleviation agenda and a health agenda that are very critical. And even the issues related to rural energy and peri-urban energy that I deal with, they become second-class citizens to just dealing with reliable energy in the urban environment, often which is fossil fuel generated. So my response directly to that question would be, on a policy level, climate change isn't going to be the driver. However, where we talk about solutions, again, in energy access that are bankable, to go to Mike's point, that are bankable, that can be invested, that the market can take the lead on, it doesn't necessarily have to happen at the top down, at the policy level. Often what we've dealt with in dealing with policy isn't so much a renewable energy or an energy policy, but an investment policy. Can private capital come into a particular market in a particular way and be fairly protected? What are the risks to the capital flowing into the market? So often it's not so much the climate policy that might be the driver of a solution, but rather the investment regime and the financial policies of the particular markets.
Graciela, do you agree that it has to be a private sector solution?
Absolutely. But you're right, Jack.
Yes.
The private sector cannot act on a vacuum and does not act on a vacuum. $400 to $600 billion of subsidies for the coal industry is not a vacuum. That's not a vacuum in which the coal industry is acting. And what's your name? And Bob knows about that. Robert knows about that. And he hinting at that. So I think, as I try to say, it's difficult to say so much in so little time, but there have to be three legs to this. There is the private enterprise, absolutely essential, because you cannot go against the private will of the producers and the business people. You just cannot do it. So you have to find a solution that is profitable, number one, and that people would like to implement because they're going to make money. Secondly, you need an environment in which the level playing field doesn't mean subsidy for the fossil fuels, which is where we are right now. Everybody knows that. In fact, the European Union and the US Congress have come up with a figure of $13 per gallon is the real cost of gasoline. So, you know, we have to start thinking about the externalities in that context. So, and what are we talking about when we talk about the regulation, what the politicians can do, okay? And there are two levels. There is the global level, it's called the global negotiations. They meet every year at the convention of the parties. Copenhagen was COP15, South Africa, Durban, that I just mentioned, was COP17. That's when the Kyoto Protocol was written. And lo and behold, the United States is a signatory and a participant in that negotiation. So for once, we are part of the world, as opposed to outside the world. So if at the local level, I couldn't agree more with Christine on the difficulty of a politician doing anything at the local level. But if you have a global undercurrent and base, the sea level base, then you can. For example, don't have to beat you on the head with that, but we need to change the price of energy so that clean energy is more profitable and dirty energy is more costly. Robert is shaking his head in the right direction.
How do we do that?
And that's the carbon market. That's what I designed, I negotiated, I got it implemented, and the price of energy in the world is in the process of changing. Because with the carbon market, for example, in California, I'm right now signing deals, business deals, with people who know they are faced with a carbon market in California that started in the year 2012. That means $10 to $20 a gallon, $10 to $20 for a ton of CO2 which is emitted. You bet your boots the strategy changes. I mean, I'm talking about a company who buy power plants and they say, wait a second, this coal plant is just not economically feasible. Why? They say $20 tax I will have to pay. It's not a tax, it's a market fee. But at that point, conversion to biomass, sure. Capture of CO2, by all means. So therefore, you need to change the price of all the goods and services in the world economy in the direction of clean energy and against dirty energy. That is exactly what the carbon market does. Because energy is the mother of all markets, and by putting a limit on the emissions and letting people trade, the cost of exceeding the limit is determined by supply and demand, by the market forces. And then at that point, you have a natural inclination of private enterprise to go in the direction of clean energy. So that infrastructure is needed, and it's having to happen. We now have carbon markets in 4 continents, and that is, at the global level, is what's needed. It's not sufficient. But then comes the final question, I would say that's where I link with Mike, absolutely, okay? Markets count? Oh, yes, they count. They count tremendously. And that's why I'm talking about this, which, by the way, changes the definition of GDP. Because all goods and services utilize energy, and if you change the price of clean and dirty energy, you change the price of everything. The price of clothes, the price of, transportation of water, this microphone, everything changes. So what you need at the end of this day is what Tom said. Because let's say that I have all the markets perfectly laid down for me, and the market is inclining in the direction of clean energy, and private entrepreneurs, particularly in the developing nations, who are doubling their use of energy in the next 20 years, are starting to move in the right direction, and they have the financial incentive, $50 billion that we send over there with the Kyoto Protocol, because that's what the money there does. And by the way, the Kyoto Protocol, I just want to say that as an aside, doesn't cost a dime. This is the first international law that has made fairly substantial transfers, billions of dollars, doesn't cost a dime. Nobody has to come and donate money. It makes money because it's market-based. So if you have that regulation, and we now have it continue until 2015 and 2020, as I mentioned before, you don't need to spend any money. You have the basic underlying structure, market structure, market structure. But then I have the market structure. I know what I should be doing. I understand that I'm going to be better off producing goods which are clean, and if I have to produce energy in a clean way for the obvious reasons, we discussed all that. I also have a huge incentive because to make money, look, the power plant infrastructure in the world that needs to be changed is worth 55 trillion US dollars. Am I wrong, Robert? Robert knows. Which means you need to change something which is the size of the world GDP. It's a monumental business opportunity. It's a great opportunity because the people who build power plants and General Electric or whatever, they're not associated, they don't have an emotional connection with fossil fuels. They have an emotional connection with making money. And they should. That's what they're there for. So if you can make money building different types of plants, you're there. And now I want to link with what Tom said, which is very important. You may know what to do, you may want to do it, but you don't have the tools. What are the tools? The technology. This is not difficult to understand. We need clean technology. So you need these three things. You need the technology, you need the private enterprise, you need the regulation, but the local regulation is difficult without the global one, and it's happening. It looks weird, but it is happening in 4 continents with the carbon market, and we're changing the global economy. The power plant industry is crucial because of what Christine says, because that's where the growth. Did you know that since the year 2000, the main growth of the world economy comes from the developing nations? That's why we have a G20, which is advertising sustainable development. So that development, that growth, is not for free. Growth equals energy. Growth equals energy. This is an equation. Therefore, they are doubling their use of energy. We have to decide whether we're going to find a way, and this is technology, so that those power plants that are going to have to be built, that are being built every 2 weeks in China, are going to be clean, or they're going to make our problem worse. And they live for 30 years. So we better try to get those lines in the right direction. Technology is crucial.
On that subject, I'd just like to ask Tom, how do you think that the revolution in shale oil and shale gas has changed that equation? You know, we've seen this enormous expansion both in production and also in potential production and reserves. Do you see now, do you believe that this has made it more difficult to persuade or to see companies and power plants moving towards non-fossil fuel sources?
Well, it certainly has an impact because, you know, I mean, you've almost seen a collapse in the price of natural gas, now down to it's about $2.90 per 1,000 cubic feet. And, you know, that means grid parity for solar is that much further off. It means that, you know, even setting aside Fukushima, nuclear is not going to make sense. It does mean a less carbon-intensive source of electricity, so it's not entirely a bad thing. And it's coupled with 2 moves on the regulatory side that are in the same sort of direction. You know, absent carbon pricing nationwide in the U.S., the 2 things that have happened are the CAFE standards, which will go up to 55 miles a gallon by the middle of the 20s, and the EPA regulation of stationary CO2 emissions, which apply to the utilities, which are effectively a natural gas standard for new electrical generation. Now, the prices being as low as they are for natural gas, actually, even absent the EPA moves, the only thing people would be building in this country are natural gas generating assets. It's an easy decision. There's not a huge capital cost. At some point in time, the utilities start to get nervous about their mix. Natural gas is volatile, even though it's very low now. You don't have to go back too far to see much higher prices. So I think there'll be a resistance to, a complete shift to kind of an 80% market penetration or something. But for the near term, that's what you're going to get. It does help in terms of CO2 emissions. I mean, it's about a factor of 2 compared to coal. So if you look at what's going to happen in this country, we see an energy intensity that's already declining. We're going to see a carbon intensity that's going to be declining. So I think over the next, 5, 10 years, it will begin to look like we're doing something, mostly because of these significant shifts in the structure of supply more than the moves we've taken in terms of regulation. The other thing that's going to happen is there's now a fairly aggressive move to push liquefied natural gas into the long-haul trucking industry. And so companies like Pilot Flying J that run, truck stops all across the country, you only have to convert 100 to 150 of them to be LNG suppliers to get a complete network for companies like FedEx and Walmart and so on that operate large fleets. And you've got Navistar making heavy-duty truck engines that will run on LNG. Again, it's still CO2 emitting, but better than diesel fuel in terms of the emissions. And so and right now, diesel fuel for heavy trucks is about 20% of our petroleum consumption, and about half of that is long-haul trucking that's amenable to this conversion. So there's a few things that are going on where the changes in the market by the enhanced recovery techniques are going to help in the near terms in sort of moderating CO2 emissions. Now, right now, the U.S. is the only market that's seen this kind of shift. But as was mentioned, that's not because those resources don't exist anywhere else. It's just that they haven't really been exploited as rapidly as they have been. And there was a time when geologists, the state geologists of Pennsylvania said, oil is a flash in the pan because Pennsylvania is the only place in the world that has this sort of geology. Well, we don't need to fool ourselves again. These same techniques and the same sorts of reserves will come into play elsewhere, assuming that the environmental issues associated can be dealt with in a way that may satisfy, more regulatory inclined in jurisdictions like Europe, where there's resistance at the moment. None of that changes the longer term question. That's where you started is interesting. Although in the near term, it'll probably make us feel good. The price matters, and it's very, very hard for any politician, whether in a developing country where people earnestly want to raise their standard of living or in a wealthy country where they want to maintain it, for politicians to say, we're going to willingly increase the cost of our energy, take the economic hit and the hit on our standard of living for something that is very hard to explain and hard to understand and many years out.
Mike, when you're looking at the kind of long-term future of energy markets, do you put much renewable generation in your models, or is it going to continue to be oil, gas, and coal for the foreseeable future?
No, renewables are, they're increasing. Consumption of renewables is, well, I guess that's an oxymoron, but the energy provided by renewables is increasing at a fairly rapid rate. The issue is you're starting from a tiny starting point. If ExxonMobil goes around and has this set of world energy long-term outlooks that they do each year, and they show a set of charts which the numbers change, but that message hasn't changed in a few years, which is they'll zoom in on renewables, and you see this wedge going like that, showing the increase of consumption. And then they show that piece, kind of buried within what they call oil or, liquids consumption. And, you can, if you look hard, you see on that scale, it's a, very thin, narrow wedge. And then when you put it in the total, energy mix, looking across all energy forms, nuclear, hydro, coal, gas, et cetera, you can hardly see it. So, I mean, that's my point. So, but having said all that, again, the consensus, energy market analysts, whether, again, banks, consulting firms, energy companies, if you compare what the consensus view is now to what it was 5 years ago, to what it was 10 years ago, the bottom line is consumption, the rates of growth of consumption are gradually coming down, more on the OECD than on the developing world, but probably even in the developing world as well. And again, consumption rates of, when you lower your growth rate, 0.1%, but carry that out, 30 years, it starts to make a difference.
Tom mentioned Fukushima. How has Japan's decision to phase out nuclear power altogether changed that equation?
Well, the announcement a few days ago, it was not totally unexpected. But Germany did the same thing within a few weeks of Fukushima, and has not really changed. We keep on coming up this, one of the common threads here is sort of the advanced economies versus developing or emerging economies. In the OECD, nuclear, I'm not saying it's dead, but growth is pretty much dead. Okay, the current time frame, a lot of plants with 30 or 40-year operating licenses are, they're being renewed because there's nothing else to substitute them. But as the next generation rolls around, or the next go around of the licenses, it's people I think are going to try very hard not to renew those. So that has had a huge impact.
And it's still not clear what's going to happen in Japan, because although they made this announcement last week, they clarified it this week. So,
but in the markets, though, we're seeing a tremendous impact from the whole Fukushima thing on the natural gas markets. One of the huge growth areas now is in Australia, in coal bed methane, and there's some discussion about how many LNG trains will be made, but there's about six in the pipeline at some form of development, and the large Japanese integrateds are showing up in the U.S. And we're getting a lot of interest from the Japanese integrateds to buy U.S. natural gas reserves and either take a position in the U.S. or in Canada, or actually build export facilities. There's one project that we're talking to a Japanese company about where they're going to build an export facility somewhere along the western Canadian coast to export LNG to Japan. So that's a huge development too. I just wanted to make one other real point about the shale gas also. I worry a lot about the shale developments, because I think it lulls people into complacency, thinking we have hundreds and hundreds of years of natural gas, and so we don't have to worry about our energy issues, and we start to not develop the renewable, sustainable sources. I worry about that a lot. Inside the industry, they won't talk about it publicly, but inside the industry, shale gas development's not economic below about $4.50 per MCF, and it's running about $3 right now. So there's a lot of capital destruction going on right now in the oil and gas business, and you see it. The rig count for natural gas rigs, Mike knows this, was about 1,200 rigs about a year and a half ago. Now it's about 435 rigs. And so our industry tends to cycle very violently. And so it's on some of these industry cycles that Mike was talking about inside the super cycles. So we are planning for a gas price increase sometime over the next 18 to 24 months. We believe.
How much?
Well, we're planning, it's about $3 now. We're planning kind of $5, maybe even $6 in some of the next
Mike,
couple of years.
what's the SocGen view?
I agree.
Most, if you're going to generalize, most people in the business think that the, kind of $3 give or take range that we've been in recently is not sustainable, because what it's doing is shutting in production. It's just not economic. Some of that might be new shale gas, some might be conventional. So most people are assuming it's longer term. It's $5, $6, $7, something like that.
Christine?
Yeah, I just want to make one point and just put it out there. We don't have time to go in it, but we've talked all about renewables and such. I want to put the issue of energy efficiency out there, because the reality is that's where, from from a reduction viewpoint, even with lower consumption, we're going to have some significant savings. Some of the reports that had come out over the years, I think it's a 2008 report by McKinsey, talked about if you invested, and I wrote the numbers down, if you invest $170 billion in energy efficiency, you're producing over $900 billion in energy savings. So I think we don't have time to go into it, but that is also a technology issue. Yeah. Very much so. What are the new technologies out there in terms of savings on energy usage and consumption? So I just want to put it out there so people, it's not just about renewables.
And that's why the CAFE standards are so important, because that's going to
but let's be realistic. We have to do something more serious than the hoping for limitation in energy growth, because the developing nations, whether you like it, I like it, they are doubling their energy consumption in the next 20 years. And they need it because they are below the consumption of basic needs, and they are 80% of humankind. Africa has enough native coal to produce trillions of dollars worth of damage to the United States if they decided to use that coal, build plants, and produce the emissions that would come with it. So the key thing, in my view, is to, and that's why as a lead author in the US lead author of the IPCC, is to reduce the carbon concentration already in the atmosphere. It's not enough to slow the emissions or even stabilizing the emissions. I tried to say that before, but I kept sounding like the Encyclopedia Britannica, and it's not very successful. CO2 remains in the atmosphere for a long time. So it's like you have a bathtub. Suppose that you start, you continue throwing water at the same rate. Since the water doesn't go out, it's just going to flood. So the only thing you can do is to try to open the spigot and allow the water out. This is equivalent to what I call carbon negative technologies. What that means, technologies that can reduce the concentration of carbon in the atmosphere. Now, take my word for it, and take the word of the IPCC that I worked for, and we need to reduce the concentration of carbon in the atmosphere, because even stabilizing emissions at this point is not going to save us from the potential risk of a catastrophe, which is the 2.5, 3, God forbid, 4 degrees increase. Therefore, the carbon negative technologies are critical. That's why I'm dedicating my life right now to that. Carbon negative technologies, as I said, can be used to turn around a power plant, which is the main emitters, but it could be any industrial plant that produces excess heat, low temperature heat, to extract air from the atmosphere and lower the carbon concentration in the atmosphere, and do so in a profitable way. You take the CO2, you sell it for food and beverages, and think Coca-Cola, think McDonald's, think Pepsi. You sell it to greenhouses. You sell it for enhanced oil recovery. Maybe you know about that, which means that when you inject CO2 in an oil well, because it is a solvent, CO2 is what you use to clean the dry cleaners. So the solvent dissolves the stuck oil, and for every ton of CO2 that you inject, that according to Shell is about $50, you get approximately 3 to 8 additional barrels of oil from enhanced oil recovery. There is enough petroleum in the US with that technology so that we are completely independent of imports for 23 years, according to the Department of Energy.
Well, that's obviously one of the many things that we're going to have to do. I'm conscious that we're running short of time, so if there are any questions from the audience? Yes.
That's part of what the CAFE standards will drive. So the challenge is that if you look at aerospace carbon fiber right now, the price point is, you can buy a $100,000 Dodge Viper that has a carbon fiber hood. You need to get it into a $15,000 car, and there's a lot of work going into that, and it does offer potentially a large enough market to absorb CO2. That's the real challenge. Once you can capture it, there's only so much soda pop. But if you can start to incorporate it into the built environment and building materials and structural materials, then maybe you've got a revenue stream associated with it that would actually make the thing work.
Well, Exxon invested $500 million in a plant, a biofuel plant in California that uses algae to produce biofuels. And they are not doing it for fun. Exxon are very serious. And they are doing it because that's, in a way, part of the future of fuels. That can be identical to gasoline and is produced by algae. However, algae cannot do it commercially without CO2. So CO2 can be used very profitably, not just for the soda pop, but also for the production of biofuels, because it enhances the productivity of the algae and it makes them commercial. And finally, the ultimate, the $3 trillion gasoline market, which can be captured by mixing CO2 with hydrogen. And if you mix CO2 and hydrogen, you produce a compound which is molecule by molecule identical to gasoline that can be sold in the gas stations. And that's a carbohydrate, carbon, hydrogen, and it is a $3 trillion market. So I just wanted to say to Tom, that's large enough for you in terms of how big is that market.
Any other questions?
Thank you, first of all. I find it interesting that there isn't a representative of solar, wind, or hydrogen products here. But my question leads to that, which is, I recently read, and this may be incorrect, so I'm asking, that Germany produces, with its solar power, more solar power than the rest of the world combined, and that it's the equivalent of approximately 20 nuclear power plants. How are they able to do that, and how are they able to do that successfully, or is it successful? If it's true. 25 cents a kilowatt hour feed-in tariffs. They decided to pay more for electricity, and it's now spread across the base.
But if you consider the externality costs of gasoline, we are paying $13 per gallon. Yes. Yes. But
So it was a
that's
decision.
where he comes in. I mean, you may need a politician to explain that point, but if you have a carbon market and you can start moving in the right direction and you stop the subsidies to the fossil fuel industry, God forbid, I don't think it's going to be easy, but if you do it, then you can do it. I mean, the Germans are bold because they know that if they decide what they want from the future, they'll get there. We are afraid of the future here. The Germans decided no more nuclear. They know they can get there. They are very powerful. They have great technology. They are very productive. So we are, after the fact, after you have made a decision, the world is open for you. There is a lot of technologies, there is a lot of policies, and there is a lot of entrepreneurial things. But before that, we're sitting here shivering in the dark because we are afraid of the future.
So all of that goes to the point that our problems are actually political. They're not technological. They're not, everything is driven by policy. So we're all sitting here, but what's the policy that's going to change, and what's going to drive that policy? I mean, all the numbers seem to work out if we do what you say, but what's going to motivate that? You're saying, is it just going to be the market forces that's going to convince the politicians to...
No, the politicians in California made a move. They have a mandatory carbon market in California. It's changing the landscape. They made a move. On the 27th of March of 2012, and Tom said that, the Obama government passed an EPA regulation supported by the executive, which according to the 2007 law passed by the Supreme Court, doesn't require congressional approval, to limit the emissions of CO2 from what he calls stationary sources, read power plants. Now, why do I mention that? It's already happened. It is politics. It went through the Supreme Court. It was challenged, what I just told you, and it was defeated. And guess what? That is the way the sulfur dioxide market started 20 years ago, and the Chicago Board of Trade SO2 market was created 2 years ago, and successfully and efficiently terminated with the problem of acid rain in the US. That first step is the Kyoto Protocol. What do I mean? The Kyoto Protocol says, okay, limits on emissions, and then you can trade. The Obama administration put the limits on emissions on power plants. When that happened for SO2, sulfur dioxide, the moment that happens, the next step is, okay, let's have some flexibility here, let's have a market. And the SO2 market was created in the Chicago Board of Trade. That first step for the creation of the CO2 market at the federal level has been taken. That step was taken on March 27, and I know that because it's my birthday. So the political step has been taken. It's just too arcane and too complicated, just as Jack said. Sometimes it's not clear to the naked eye that all these things are happening, and it's too complex. But the political step has been taken.
Just very quickly, in South Africa, they've created a feed-in tariff program. And we were all very excited about that, creating that, because there's evidence in the European markets, in Germany in particular, about how that enables, and it's really enabling versus directing, enabling private sector to come in. There is a 6-year backlog of projects because they didn't build the capacity within the government to deal with the projects that would be coming through, nor did they put in place the financial streams to fund the 25 cents a kilowatt hour. So the policy is an enabler, and it's one piece, and Graciela said this, it's one piece of what has to fall into place. But by itself, it's not going to succeed.
Thanks very much. Do we have time for any more questions? Unfortunately not. I'd like to thank the panel very much for joining us, and thank you to the audience for being here. I'm afraid I don't think we quite solved the problem of climate change, but perhaps we threw it open slightly, so thank you very much all indeed.
Thank you, Jack.